You don't see it. You don't feel it. But right now, a 3-digit number is quietly deciding what kind of life you're allowed to live. Not your intelligence, not your income, not even how hard you work. Just a score. And the strangest part, you didn't vote for this system. You didn't sign up for it, but you're already inside it. Because today, your credit score doesn't just measure your finances, it controls them. It decides whether you get the apartment or the rejection email, the car or the higher interest rate, the business loan or the polite, "We regret to inform you." Same person, same effort, different number, and suddenly, different life. Here's where it gets uncomfortable. Most people think a credit score is just a reflection, a simple report card of how responsible you are. But that's not quite true. A credit score is not just measuring your behavior, it's shaping it. And once you see how it works, it's hard to unsee. Let's start simple. Imagine you've never borrowed money before. No credit cards, no loans, no debt. Sounds responsible, right? In reality, you're invisible. Because the system doesn't reward you for avoiding debt. It rewards you for managing debt. No history doesn't mean safe. It means unknown. And in finance, unknown is dangerous. So the system nudges you. Get a credit card. Take a small loan. Prove you can borrow and pay back. At first, it feels harmless, even smart. Build your score, unlock better rates, gain financial freedom. But here's the quiet twist. To improve your score, you need to stay in the system. And staying in the system means staying in debt. Not drowning in it, just maintaining it. A little balance here, a monthly payment there. Always active, always tracked. Because your score is built on a few key behaviors. How often you borrow, how much you owe, how long you've been borrowing, and how consistently you make payments. Miss one payment, your score drops. Max out a card, your score drops. Close an old account, your score can drop. Even checking your credit too often can nudge it downward. So now you're not just living your life, you're managing your score, carefully, constantly. And that's where the system gets interesting, because it starts to influence decisions you wouldn't normally think about. You hesitate before paying off a loan early, because it might hurt your credit mix. You keep an old credit card open, even if you don't use it. You spread out payments, not because you need to, but because the algorithm prefers it. At some point, you're no longer optimizing your money, you're optimizing your profile. And that profile, it's being watched. Not by one bank, not by one company, but by an entire network of lenders, insurers, landlords, and even employers in some cases. All looking at the same number, all making decisions based on it. And here's where the math gets uncomfortable. Let's say two people want to buy the same car. Same model, same price, same dealership. One has a high credit score, the other, average. The high score borrower gets a 4% interest rate. The average one gets 9%. Over a 5-year loan, that difference isn't small. It can mean paying thousands more for the exact same car. Same product, different price. Not because of income, not because of effort, but because of perceived risk. And perceived risk is what the system sells. Because from the lender's perspective, the score is a prediction, a probability, a guess about whether you'll pay them back. And the higher your score, the more you're seen as safe. But here's the irony. The people who need cheaper credit the most usually have the lowest scores, and the people who need it the least get the best rates. So the system doesn't just measure inequality, it can quietly reinforce it. Lower score, higher interest. Higher interest, harder to pay off. Harder to pay off, score stays low. A loop. A very profitable loop. And it doesn't stop at loans. Insurance premiums can be affected. Rental approvals can be affected. Even phone plans and deposits can change based on your score. So now the number isn't just about borrowing. It's about access. Access to housing, to mobility, to opportunity. And all of this runs in the background. No dramatic announcements. No visible switches, just quiet decisions being made, over and over again. Now here's where the story gets even stranger, because the system is often marketed as a path to freedom. Build your credit, unlock better deals, gain financial control. And on the surface, that's true. A strong credit score can open doors, lower costs, give you flexibility. But look closer. That freedom is conditional. You're free as long as you keep playing the game, as long as you keep borrowing responsibly, as long as you stay predictable, as long as you remain within the system's expectations. Step outside those patterns, and the system pulls back. Score drops, rates rise, options shrink. So it's not pure freedom, it's structured permission. And the structure is designed to keep the system running. Because at its core, this entire ecosystem depends on one thing: people borrowing money. Not once, not occasionally, continuously. Credit cards, auto loans, mortgages, personal loans, each one feeding data back into the system, each one reinforcing the score, and the score guiding the next decision. It's a feedback loop, and like any loop, it has momentum. Once you're in, it's easier to stay in than to step out. Now, to be fair, the system isn't entirely broken. It does solve a real problem. How do you lend money to millions of people without knowing them personally? You need a shortcut, a signal, a way to quantify trust. And that's what a credit score tries to do: compress your financial behavior into a single number. Simple, efficient, scalable. But simplicity comes at a cost, because real life isn't a number. It's messy. People lose jobs, they get sick, they make mistakes. A missed payment doesn't always mean irresponsibility. But in the system, it often looks the same, and the algorithm doesn't ask why. It just adjusts the score, quietly, instantly. Which brings us to the part most people never think about. Your credit score isn't just a record of your past, it's a prediction of your future. And once a prediction is made, it can start to shape what actually happens. Lower score, fewer options. Fewer options, tougher conditions. Tougher conditions, higher chance of struggling. The prediction becomes reality. Not always, but often enough. And that's where the power lies. Not in what the score says about you today, but in how it influences what happens next. So when people say, your credit score determines what you can afford, that's only half the truth. It also determines what you're allowed to access in the first place, which raises a quiet, uncomfortable question. If a system decides your financial opportunities based on a number built from your past, how much of your future are you actually choosing? And how much of it has already been decided before you even apply?